Okay, thank you very much. Um, this is our first topic in financial management.
Okay.
Yeah. It holds most of the basic ideas that you need as a student in financial management. And a good understanding of this unit will help and make financial management very simple for all of us as we are studying. So as you look at the objectives there, we are supposed to understand the nature and the role of financial management. Okay. We are also supposed to understand the general financial environment and the operation of financial systems. We are also supposed to develop the ability to apply the tools of financial analysis and interpret financial results. We must be able to develop a working knowledge and understanding of theoretical framework and analytical techniques involved in investment and financing decisions and working capital management. These are some of the issues that we need to understand as we begin this course. So that's what is contained in this syllabus. We'll look at an overview of corporate finance or financial management as it may be called. We'll also look at financial environment, sources of finance, the time value of money, bond valuation, stock valuation, cost of capital, capital budgeting, risk and return, dividend policy, and we'll end with working capital management. So basically we have about 11 topics that we're supposed to cover, but in the interest of time, we'll be seeing what important areas that must be covered no matter how little our time can be. So first thing first, we need to understand, why are we taking financial management? Why are we studying financial management? Okay. So
Hello.
Hello, you want to log in with a different device?
Yes, I'm trying to use my laptop.
Okay. So we are able to disconnect one?
Yes, you can disconnect my phone.
Okay, yeah, so just switch off the phone so that I admit you with a laptop now, because I'm seeing you are supposed to log in with a laptop.
Okay, let me go out there.
Okay. Are we able to continue? Hello? 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 Hello?
Yes, I can hear you now.
Okay, thank you very much. So we can continue. We want to first start with understanding why are we studying financial management. Now, I always tell people that if you don't know where you are going, then it doesn't matter how you get there. If you don't know where you are going,
Okay.
it doesn't matter how you get there. So financial management is very important if you know where you are going. Once an organization has established its mission statement, its vision, then it knows where it is going. And financial management, we will help an organization get to the destination where it is going. So that's it. In this chapter, we are going to look at what financial management is, what are the goals of the firm, then corporate governance, and organization of the financial management function. So, what is corporate finance or what is financial management? So, what we are saying is it is just an activity involved in managing cash flows in a business environment. So, as a finance manager, your job is to manage cash flow in a business environment. So that is basically what is financial management. Now, there are 5 basic functions of corporate finance or financial management. If you look at this presentation, you are able to see that these 5 functions, they are all behaving like a ladder, taking the organization to a certain level in the business. One of the functions of financial management is corporate governance. We are going to learn what is involved in corporate governance. Basically, it is just the system or the way corporate institutions are governed and controlled. The other function of corporate finance is risk management. You know, you are managing other people's money. Shareholders have invested in that business. So you must be able to provide assurance of your risk management strategies. We are also going to look at the function of financial management, the actual financial issues that you'll be handling. Then the fourth function is financing. Now, financing, it is an activity involved in the raising of capital. Each and every time you identify a business opportunity, you need to raise money to invest in that business opportunity. So that is what is called financing. Then the fifth function of financial management is capital budgeting. Capital budgeting, it is a subject or a topic on its own that we're going to study. It involves the investment of resources into assets. So these are the functions. If you look at this table here now, they are given, there's now the full explanation of what is risk management. Managing firms' exposure to all types of risks. That is your function as a financial manager. Each and every business is exposed to different risks. So the first thing that you should do, you must identify the risks to which your business is subjected to. If you are dealing in a certain type of business, it doesn't mean everyone in business is experiencing or is exposed to the same type of risks. So different types of businesses are exposed to different types of risks. So as a manager, you must be able to know what risks are your business subjected to. That is what is involved in risk management. Once you identify them, you must measure them and know the impact. If we don't control this risk, what happens to our business? The moment you measure the impact, then you know how much effort must be targeted to that risk so that you minimize the occurrence of that risk. The next function is about financial management. In financial management, you are trying to manage firms' internal cash flow and its mix of debt and equity. You must be able to know how are you going to mix your money. Debt is representing the money that we borrow, and the equity is representing our own money. So when we mix, that could be the type of capital that we have. So you must consider the costs that are involved. If we borrow money to be put in business, what is the cost? What if we take our own money, equity, money from shareholders, we put in business, what will be the cost? Then you find the one that has got less cost, that is what you concentrate on. That is how you handle the financial management function. The third one is about financing. You want to raise capital, which is similar to what we are discussing. So you have got options. It's either you are going to issue shares, which investors should buy, or you are going to go to the bank and borrow the money. So all these costs must be considered as you are raising your capital. Corporate governance. Corporate governance is a very serious aspect in the management of corporate entities. The way an entity is governed and controlled has got an impact on its prosperity, on its success. So you must have a policy that will promote good corporate governance principles. The last one is capital budgeting. How do you invest the resources of the firm? So you must do what is called investment appraisal. If we have got money as a business, we want to invest this money, we must do an evaluation of each and every investment to see the returns that we are going to get from such an investment, so that we're able to guide the shareholders in which business should their money be put. Otherwise, there will be drama if we mislead them. So, before we move to the 3 decisions that are made in financial management, is there any question on what we have discussed? The 5 functions of financial management.
No, we are okay.
We are okay. Okay, thank you very much. So, we need to understand that there are 5 functions of financial management.
Yes, sir.
And there are 3 decisions in financial management. So let's look at the 3 decisions in financial management. So, as a financial manager, you must be able to make what are called investment decisions. Here is the money. The company has made enough profit. You have paid the shareholders dividends, you have paid all the obligations, and you are still remaining with money. What do you do with this money that you have remained with? Are we just going to keep it in the bank and start paying for service fees? I think shareholders wouldn't entertain that. The moment you have got extra money, it must be invested. So you must provide guidance to arrive at an investment decision. Where are we investing our money? So we will look at the risks of each and every investment. Then we look at the return. So an investment with the highest return takes precedence. That is how we make investment decisions. Of course, we will understand this better as we'll be dealing with the investment appraisal or capital budgeting. The second decision that is made in financial management is financing decision. We are in the process of raising capital. How are we going to raise our capital? If we want to raise some money to invest, how are we going to raise this money? These are the decisions that are called financing decisions. How do we raise the money that is needed? If we are to borrow, what are the costs of borrowing money from the bank? If we are going to offload shares on the stock exchange, what are the costs that are involved? Then you are going to make a financing decision. The third decision we are going to make is called dividend decision. Once the company has made profits, we must make a decision of how do we pay our dividends. That's very important. Remember, shareholders have brought their money because they want dividends. And believe you me, the better the dividends we pay to the shareholders, the more attractive our business will be in the stock exchange. So it is a very important decision how to pay or how to manage the dividends. So, investment decisions, we are identifying it as the most important of the 3 decisions. Of these 3 decisions, the most important decision is the investment decision. Now, there are issues that we need to consider when making an investment decision. What is the optimal firm size? So we need to know how big is our firm. You know, sometimes we must measure ourselves as we are taking up certain decisions. Otherwise, we will jump in the football pitch where we cannot play. So you must understand the optimal size of your firm. You also look at what specific assets should be acquired. Having known the size of your firm, what type of assets should you have? That is how critical investment decision is. You must also look at what assets among the assets that you have, if any, should be reduced or eliminated. Sometimes firms are keeping assets that should not be kept. Sometimes firms are busy buying assets which should not be bought. It's because there's poor investment decisions. So these are decisions that have to do with the firm deciding on what investments it wishes to make. It also includes determining what assets to invest in. And the decision-making process involves selecting viable projects by applying investment appraisal techniques, depending on the nature of business the firm is involved in. If you look at a mining firm, when they are making investment decisions, they have their own issues to consider. You look at a retail firm, you look at manufacturing and tourism. So depending on the type of industry or business you are in, you have your own way of making investment decisions. Okay. Now, in investment decisions, there are two things that are very important to look at. Okay, so
Yes, sir.
there are two things that are very important when you are making an investment decision. There's what is called the hurdle rate. So the hurdle rate is a rate that reflects the riskiness of the investment. If, for instance, Mr. Kunda, you want to invest in a textile machine, you must be able to know what risks are involved in the textile industry. So that is what is called the hurdle rate. So the riskiness of the investment and the mix of debt and equity used to fund it. So this rate, we are looking at how risky this investment is. Then if you mix your debt and equity to fund it, how safe is that business? Okay. The next thing that you need to consider is the return. Believe you me, you can't take your money, put it into business that cannot give you a return. There's no one who is interested in that. Business, my brother, is all about profit. If a business can't give you profit, it is not worthy to be a business. So return is a very serious aspect that should be considered in an investment decision. So a return reflects the magnitude and the timing of the cash flows as well as all side effects. People have brought in their money. What is it that they are getting out from this business? Okay. So that is how important investment decision is. When you look at financing decision, it's all about what is the best type of financing. Should we use debt financing where we borrow money? We are also looking at what is the best financing mix. how much debt should we mix with how much equity? That is what is involved in the mix, financing mix. So these are the decisions that are falling under financing decision. Now, you also need to know, if you want to raise money, how will this money physically be acquired? How are we going to get this money? So that must be considered at the financing decision time. Okay? The dividend decision. Now, under the dividend decision, as we mentioned earlier, we are making decisions concerning the dividend policy for the firm. It describes how the returns from the investment are contributed to shareholders as dividends. They are expecting dividends at the end of the year. And you imagine, at the end of the year, you are the directors of this company, you don't have the ability to pay dividends. The following year comes, you can't pay dividends. Do you expect some more people to invest in that business?
No.
Exactly. So you're going to have two things. No new investors, then the old investors will start selling or transferring their shares so that they get their money and move out of this business. Now, because you can't pay dividends, the attractiveness of this business is very low. So the prices of your shares will go down. So it's a disaster. At the end of it all, we just hear of the liquidation. So those are the issues. So that's what is all about the 5 functions of financial management and the 3 decisions in financial management. I'll pause a bit to give you time if there's any comment or any question before we look at the goal of the firm. Why do firms begin business? Any comment or any question?
No,
It's
no,
fine.
we are together. It's very clear.
Thank you very much.
I'm able to relate. I'm able to connect what goes on at work
Exactly.
and what we look at and what we are learning.
Yes. Thank you very much. Let's look at the goal of the firm. The possible goals of the firm. Now, every organization that is in business, there are 4 things that they are very interested in. Number 1, they should avoid bankruptcy and financial distress. As a firm, we should avoid bankruptcy. The moment we are declared bankrupt, I'm telling you, the company is liquidated. So one of the goals of the firm is to avoid bankruptcy and financial distress. The second goal of the firm is to minimize costs. Try by all means to minimize costs. You know, there's a relationship between profit and cost. So if we minimize costs, possibilities of maximizing profit is there. So it is one of the goals of a firm to minimize costs. The third goal of the firm is to maximize sales. You must aim at maximizing sales. We are in business because we're able to make sales. If you can't make a sale, how? You are kicked out of business faster than you came. So it is one of the goals of the firm to maximize sales. Another goal of the firm is to maximize the profits. You know, at every business level or operational level, you must ask yourself a question. Is this level of operation giving us the maximum profit? There are a lot of situations when we are doing business at a level where we are not maximizing profit. Okay? You will learn that if we are in economics, we need to identify the profit maximization level. So we'll be performing or we'll be operating at that level.
Yes.
Okay? Yes. So that's that. Our meeting may cut in 10 minutes time, that then we will log in back. Okay, so
Okay.
these are the goals. Now, if we are talking about a publicly traded firm, there are 3 goals. The first one is maximize share price. It is also called maximization of shareholder wealth. Because the moment the share price is going up, then shareholder wealth is increasing. Okay? Then the next goal is to maximize market share. Believe you me, as an organization, you must be increasing your market share. The more share on the market, the more market share you are enjoying, the more sales you are making. So that is another goal. The third goal is value creation. You must be able to create value in that firm. Okay? Okay. Now, this traditional corporate financial theory for maximizing stock share, you know, it is very easy for people to understand shareholder maximization or shareholder wealth maximization because it is very easy to observe it. If, for instance, you tell me that at the time you were buying the shares in that company, the share price was at 10 kwacha per share. So, how much do you invest? Because you are buying 100 shares. So, you are saying 10 kwacha multiplied by 100. You have got wealth amounting to 1,000 at the time of your investment. Then, because this company is doing fine, there's a high demand on the market for the shares in this business, the share price goes up. So after 3 years, the share price in this organization is at 25 kwacha. You have got 100 shares. So 25 kwacha multiplied by 100 shares, how much do you have? You have got 2,500. Have you seen that your wealth has increased?
2,000.
Exactly. So, an increase in share price is the very easiest way of knowing shareholder wealth maximization. So, at the time of your investment, you only invested 1,000 and you got 100 shares. Today, your wealth in this company is sitting at what? 2.5 million. In most exam papers, the way this question is the way they bring it. So you must be able to explain why traditional corporate financial theory Okay, why is it that it looks at maximizing stockholder wealth as an important aspect? Okay, okay, why traditional corporate financial theory focuses on maximizing stockholder wealth? So these are the explanation. Because stock prices are easily observable and constantly updated. Because you know that last year the share price was 10 kwacha. So go to the stock exchange. What is the share price this year? Oh, it is at 25 kwacha. Oh, shareholder wealth has increased. So that is the reason. Okay. Are we able to move?
Yes, sir.
Thank you. So when we are talking about shareholder wealth maximization, what are the strengths or the advantages of this? Now, it takes into account the following. It is able to tell you the current and the future profits. The moment you look at how much is the share price today, how much was the share price yesterday, you're able to know how much profit you have made. You look at the timing, duration, and risk of the profits. Okay? You're able to measure the timing and the duration. You are also able to see the dividend policy. What dividend policies are available in this business? You're also able to see other relevant factors. So, a share price serves as a barometer for business performance. Do you get that? As we looked at this, if the share
Yes.
price increases, it is evident that there's demand for that share on the market. So if there's demand for that share on the market, it simply means this company is performing well. So a share price is an indicator of business performance. So that is the reason why shareholder wealth maximization is used so traditionally in terms of company performance. You are able to trace it easily. Okay. There are shortcomings when it comes to profit maximization. Okay. There are times when you can increase profit while you are still harming the firm. You know, when we are targeting profit maximization, we might be disadvantaging the firm. Imagine you are in a perfect competitive firm where there's competition and I'm trying to reschedule the meeting.
Okay.
Yeah, just a bit so that we, as soon as it cuts, we are able to connect so that we finish up. We make some progress very fast. We'll maintain the same. We'll maintain the same meeting IDs. Okay.
Okay.
Yeah. Okay. So Okay. So these are some of the problems. You want to maximize the profit on the expense of the company prosperity. Yes, you are making a lot of profit, but because of the way you are making this profit, it can disadvantage the company. So those are the shortcomings of profit maximization. The other thing is it ignores changes in the risk level of the firm. Because you are interested in the profit, you don't mind what risks you are exposed